Today we will be talking about 3 stocks that I own in my personal high growth stock portfolio. These 3 stocks are each up over 100% in the last 2 months. Yes, you heard me right, 100% in 2 months. That means you could have doubled your money if you had bought any of these 3 stocks at the bottom of the market. But before we get into the video, please consider clicking that subscribe button. This channel is growing fast and I don't want you to miss out on any of the amazing videos I put out each week. At least, I think they're amazing, but I might be a little biased. The 3 stocks I will talk about in this video are stocks that I have held in my high growth stock portfolio for many years. And instead of being fearful, I have consistently bought into them during that time. When people were screaming that the stock market was overvalued, I was buying. When people were yelling that the world was ending just 2 months ago, I was buying. And I will continue to buy moving on into the future. And this is a strategy that I have used for a long time. The strategy is simple. Step 1, select stocks of high growth companies. Step 2, buy more shares of these high growth stocks each and every week. And step 3, ignore what is going on in the world and live a happy life. Yeah. It's really a simple strategy, but the most important step is correctly identifying the best high growth companies to invest in. Because if you pick bad stocks, you're going to lose money. And when it comes to picking only the best high growth stocks, you are in luck because I have 3 of them I will share with you in this video. So let's first talk about the benefits of adding some of these high growth stocks to your portfolio. The biggest benefit is the potential for massive returns over the long term. These are not double your money in a day type of stocks and then sell them before they crash. These are stocks of companies that have a number of positive indicators that only the smartest of investors take advantage of. And when you buy these high growth stocks, you have to be willing to take some abuse. For example, people might say, "Justin, those stocks are way too risky." "Justin, those stocks don't pay dividends." Or, "Justin, those stocks are too overvalued." And really, these comments don't bother me because I know that I am winning. And I want you to win too. In fact, if we look at my Fidelity brokerage account, we can see I was able to achieve a 130% gain over the past year. Yes, that's right. Even with the coronavirus pandemic decimating people's portfolios, I was able to achieve a 130% return. Compare that to the S&P 500, which is up a measly 0.86% over the same time period. So if you are a new investor or you've not been investing for very long, it's possible for you to achieve these type of results if you watch this video and if you take the advice that I'm giving you. And really, when you watch videos on YouTube, it is hard to know who to trust because right now there's a lot of big YouTubers out there in the finance community that are telling you to sell all your stocks or are making videos about how they are selling a lot of their stocks in preparation for another stock market crash. But really, that is not what I am doing, and that's not what I recommend you do. Investing seems complicated, but it is in fact very simple. Like I said earlier, find the best high growth stocks, consistently buy into them, and then never sell them. That's it. And never selling is a very important part of investing because investing does take time. And it does not work very well when you are constantly selling your investments and second guessing yourself. In fact, over the past month, instead of selling a single share of these great high growth stocks, I bought more of them. And I'm buying more right now. And I'll be buying more every single week, regardless of whether the stock market is up or down. Instead of trying to time the market, I rely on time in the market to make most of my money. See what I did there? Maybe you've heard of that before. And when it comes to these high growth stocks, I am way more likely to lose money by waiting to invest in them. So whenever I get paid, I put as much of that money as I can into these high growth stocks as quickly as possible. So enough talking, let's get into the video. The first stock on my list is The Trade Desk. ticker symbol TTD. The Trade Desk is a software as a service technology company that operates a self-service cloud-based platform that allows buyers to create, manage, and optimize data-driven digital advertising campaigns. These campaigns can be run on a variety of different devices, including computers, phones, and even smart TVs. Basically, the Trade Desk is the future of advertising because more and more people are canceling their cable subscriptions and switching over to streaming. And as regular cable subscriptions continue to drop and the devices that people use to consume content expand, the Trade Desk is positioned to get even a larger amount of advertisers' money moving forward. The Trade Desk currently has 820 clients and boasts a 95% retention rate. So advertisers clearly love using the data-driven, on-demand advertising tools that the Trade Desk provides. Now, the Trade Desk does have a number of competitors, but only one of them is publicly traded, and it is much smaller than the Trade Desk. The Trade Desk does have a market cap of $13 billion, which makes it a large cap company that has been around for over 10 years. Overall, I like the Trade Desk for its large size, proven track record, high customer retention rate, and innovative smart solutions. And really, the Trade Desk is going to continue to grow and gain market share, in my opinion, as more and more people switch from cable to streaming. Of course, the stock is overvalued if we base it off of traditional fundamental numbers today. However, the metric that is very important for measuring high growth stocks is the revenue growth. So let's take a look at Yahoo Finance to see what the Trade Desk's revenue growth has been for the last couple of years. If we look here at Yahoo Finance, we can see that the Trade Desk has grown its revenue by roughly 50% per year over the past 3 years, which is really good. On top of that, they are also profitable, reporting $20 million in profits in 2016 and $100 million in profits in 2019. That is a 400% increase in just 3 years. So I'm very happy with the revenue growth that this company is showing and that it is already profitable, even though it is still a relatively small company. So clearly this is a company that knows how to execute, and that's why I am recommending the Trade Desk for your high growth stock portfolio. All right, next on the list, we have none other than Shopify. Now, I have been bullish on Shopify for a long time, and I believe in it so much that I have put 50% of my money into it for the past 3 years. I first bought Shopify at $77 a share, and it is now trading at over $700 a share. So my initial position, I am up about 750%. So why do I like Shopify so much? Well, let's first talk about the service Shopify provides. Shopify is another one of these software as a service companies that I talk about all the time, and it provides a cloud-based e-commerce platform to small and medium-sized businesses. Basically, if you want to start an online business, you need at a minimum to build and design a website, and then you will also need to add a payment processor. But in order to make your online business thrive, you need much more than that. And that's the value that Shopify provides. It allows anyone to easily set up and manage an online e-commerce store for a low monthly fee of $29. As your store grows and you need more support, you can add more functionality to your store by paying Shopify more each month. The reason Shopify is one of my top stocks is because its focus is on supporting merchants. And the company is supporting merchants by expanding their services to include fulfillment and logistics, such as 2-day shipping. So basically what this means is that instead of being forced to sell your items on Amazon and pay a hefty commission, you can establish your own brand and keep more of the profits while still being able to provide the same level of customer service as Amazon does. And with third-party sellers accounting for the majority of Amazon's revenue growth over the past couple of years, I think that Shopify is set up to be very competitive with Amazon and even take away market share from them moving forward. In my opinion, what Amazon did to brick and mortar stores such as Walmart is similar to what Shopify will do to Amazon. In fact, Amazon launched a Shopify competitor in 2010 called Amazon Web Store, but was forced to close it in 2016 due to poor performance. Meanwhile, Shopify has endured and even gotten stronger. And while Shopify is not yet profitable, it has been able to grow its revenue tremendously over the past 3 years. If we look at Yahoo Finance, we can see here that the revenue has grown from $389 million in 2016 to $1.5 billion in 2019. So clearly this is a high growth company that is executing very well. And in terms of profit, Shopify is not yet profitable. but it is trying to remain competitive, and that requires a lot of investment back into the company. So the lack of profitability does not worry me one bit when it comes to Shopify stock. Okay, the final stock I want to talk about today is a controversial one. And what I mean by that is that people either love it or they hate it. So which stock is it? Well, it's none other than Elon Musk's Tesla. Yes, Tesla. Some of you might be disappointed that I'm bringing up Tesla in this video, and some of you might be very excited. But basically, Tesla is most well known for its electric cars, and it also offers a wide range of other energy products, including energy generation and storage solutions. And really, that's just a fancy way of saying battery packs and solar panels. The reason I hold Tesla is because of the vision that Elon Musk has for the company. Whether you agree with me or not, Tesla will do to the other car companies what Apple did to phone manufacturers BlackBerry, Nokia, and Motorola. Tesla has a stranglehold on the US electric car market, accounting for over 70% of electric car sales. And one of the biggest criticisms of Tesla is not really a criticism of Tesla itself, but rather a skepticism of electric car adoption. For a lot of people in the US, electric cars are not feasible because of the range and charging limitations. And really, as someone living in Kansas, it's not really feasible for me to own a Tesla as my only car because of these reasons. However, the technology is only getting better and better, and as it does get better, the range will only increase. And the charging times will also decrease, which will help a lot. What I see happening is sometime in the next 10 to 20 years, most middle-class families will have 2 cars. One will be a larger gas-guzzling car for long trips and vacations, and the other will be a smaller electric car meant as more of a commuter car for maybe work or running errands around town. The electric car can be parked in the garage each night and fully charged by the morning. And really, that is Tesla's vision, to be a vertically integrated company that offers energy solutions for customers. You buy the car, you buy the solar panels, and you buy the battery packs. The solar panels are the energy generation, the battery pack is the energy storage, and the car uses the energy that is generated and stored. You also have Tesla's self-driving software, which I believe is well ahead of other car manufacturers, and Tesla's brand power, which is on par with Apple. So these two things combined make Tesla a very strong company moving forward. And also on top of that, you have car sales ramping up for the company, which is resulting in an increase of revenue. So let's look at Yahoo Finance to see what the revenue has been for Tesla over the past couple of years. We can see here that Tesla has grown its revenue from $7 billion in 2016 to $24 billion in 2019. And even though Tesla has booked net losses each year, its losses have remained steady at around $1 billion per year. This is because Tesla is investing quite heavily into a number of things, and I am not worried because of the strong revenue growth that we are seeing from them. So in my opinion, Tesla is a company that will be around for many years to come, and I believe they will continue to grow their revenue over the years and gain market share. Those are 3 of the high growth stocks I have been buying heavily over the past 2 months, and I really encourage you to add them to your portfolio, maybe as a small position at 1 to 5%. And as you get more used to the volatility and you can handle the volatility of these stocks, maybe you can increase those percentages. But I really think you have nothing to lose by adding Tesla, Shopify, or the trade desk to your portfolio, maybe 1%, 2% of your portfolio, and just see what happens. And guys, when I talk about volatility, you need to make sure you are really evaluating companies on their long-term growth potential, because companies do go up and down, and if you are simply chasing the hottest stock of the day, you can really get yourself into trouble. Therefore, these 3 companies I talked about in the video are stocks that I believe have the ability to outperform the stock market over a period of many years. So keep buying them each and every week, and I guarantee you guys, if you hold them for a long enough period of time, you are going to see huge returns from these 3 stocks. So thanks so much for watching, guys, and I'll catch you in the next one.